Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jim Jackson, Co-Chief Investment Officer and Head of Fixed Income Portfolio Management with Victory Capital. He joins me to discuss how the stress on the banking system influences Fed policy decisions and portfolio positioning. Jim, it's great to see you again. Welcome back to Trade Talks.
Nice to see you as well, Jill. Thank you.
Since we spoke in November, there has been quite a lot of volatility. How has that impacted the fixed income markets?
You are correct. A lot has gone on since then. And the last time we spoke, we were really in the midst of the worst year for fixed income in more than 40 years. So at the end of 2022, the Bloomberg US aggregate finished down 13% for the year. The magnitude of that is really that the next worst year was only down 2.9%. So it was a truly historic drawdown in the fixed income markets. Now, when we started 2023, fixed income performed fairly well. Rates came down somewhat. There was an expectation that maybe the Fed was either going to slow its pace or start to cut towards the end of the year. Those concerns or that optimism was fairly short-lived. When we moved into February, growth was stronger. Inflation was not coming down as fast as the market expected. Rates started to move back up somewhat. And then, of course, when we entered into March, there was significant stress in the banking area, which was really started with Silicon Valley Bank.
Can you elaborate on the banking crisis?
Sure. So really to start off, it is our view that this is not 2008, 2009, right? So it's really what we saw during that time period was stress in the markets based on credit and based on leverage. This time, what we're seeing is the stress in the banking space was driven by really the increase in rates that we saw in 2022. So what a bank does is a bank basically borrows very short. You put your money into a bank and they lend long. So a primary purpose of managing risk in a bank is to manage that sort of mismatch. Silicon Valley Bank apparently did not do that well. They had deposits coming out of the bank. They needed to sell assets to meet those. And the assets that they ended up selling, given rates had went up, the value of those assets went down. They had to sell them at a loss. The market became concerned. Depositors started taking money out of the bank at a very fast clip. And at that point, the bank failed. And that's when the Fed had to step in to save the bank. And that's really what started this whole banking crisis over the last couple of weeks.
And how has it evolved since?
So really, it's evolved. There was really one more bank that failed after SVB. At that point, the Fed stepped in, guaranteed all the deposits at these two banks, and they also opened up a lending window. So, and what was different about this is that banks could come and they could borrow at the par value of bonds rather than the market value of bonds. So this, it didn't completely relieve pressure in the banking system. We really started to see pressure on primarily the regional banks as deposits started to move from the regional banks to the money center banks. So after that started to happen, that certainly has slowed somewhat. The pressure is not as heavy currently on the banking system, and we haven't really seen a bank fail since Signature Bank.
And how did all this influence the situation with Credit Suisse?
Sure. Credit Suisse, they really have had a long-term stream of problems at that bank. Now, management has changed. They've been looking to sell some business units, reduce risk at that bank. However, the stress in the U.S. market really turned attention to Credit Suisse. So although Credit Suisse from a fundamental basis would not appear to have a problem with capital, the market and counterparties started to lose confidence in them. And once confidence is lost, it's very challenging for a bank to stay afloat. So at that point, counterparties market customers really became uncomfortable dealing with Credit Suisse. Basically, the Swiss orchestrated a purchase of CS by UBS. This required certain bonds called AT1s to be written down to zero, but it did provide Credit Suisse a lifeline, and it seems at this point to have put the intensity of at least the current banking crisis behind us,
Right.
at least for now.
So, Jim, how do you think all this influences the Federal Reserve's monetary policy decisions?
I think this puts the Fed in a very challenging role. On the one hand, they're still trying to bring inflation down, but on the other, they don't want to increase rates to the extent that it causes further stress with banks. So really, the market has started to price in a much less aggressive path for the Fed. They raised rates 25 basis points yesterday. They still indicated that they are concerned with inflation, but that they expect that this banking crisis that we've seen to actually be fairly contractionary, right? So I think this really does soften the Fed's path going throughout the rest of this year.
What does this mean for fixed income investors?
Really, Joe, we've still seen some of the highest yields we've seen since 2008, 2009. Current yields are really a good indicator of what you can expect returns to be in fixed income over the time periods of which a bond is outstanding. So we still think it's a fairly compelling time to add bonds. And also, I would note that over the last 3 weeks, when the stock market sold off quite a bit after SVB failed, that bonds provided meaningful support to overall meaningful support, meaning bond prices went up while equity prices went down.
What would this mean for other parts of the bond market, particularly corporate bonds that might be more exposed to a recession?
Sure. Corporate bond spreads have widened over the last couple of weeks, but certainly not near a level that would indicate any further stress. Corporate balance sheets are generally in good shape, but however, profits have started to fall. So we're really thinking we're fairly cautious on corporate bonds right now.
And finally, what does this mean for portfolio positioning?
Sure. Within our funds, we have been fairly defensive with regards to our holdings in corporate bonds and high yield bonds. We really follow a fundamentals focused, research driven process, and we think that is very important in an environment like now with such large apparent credit risks that are out there.
All right, Jim, I appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.